Hi, welcome back. This is the second part of our stock trading webinar. Thank you for those of you who have joining us, as I said, for this second session. But as always, because we're starting a new video, can I just draw your attention to the disclaimer, which I know you can see on your screen. As you know, trading can be a very risky business. So please don't ever think of using money that you cannot afford to lose. And as always, we will be looking at some more charts. We've been looking at Williams Brothers in the first part of this webinar through the prism of volume price analysis, which is this intimate relationship between price action and volume, also support and resistance, candles, candle configurations, candle patterns, and time, looking at multiple time frames. And as I explained earlier, the book, the complete guide, gives the basic concepts, but there's also a companion book with 200 worked examples of stocks, indices, and commodities. And there's also a version for Forex as well. The charts that we saw earlier, some of them were just plain charts, vanilla charts, but we have developed our own indicators to support the methodology. David has them on his platforms as well. I'll be passing over to David in a moment, but they're available for MT45, NinjaTrader, TradingView, and TradeStation. And as I mentioned earlier, we are also working on a very comprehensive stock trading program. I think it's probably going to be even bigger than our Forex trading program, and that's saying something, and we're working as fast as we can to get that completed. We will be putting up a sign-up form on my site if you want information of when that is available. Right, we were looking at sectors, sector performance, digging into sectors. Are they at the best performing sectors, the worst performing sectors? Then looking at individual stocks within the sector, using the ETFs and the percentage, the weightings that individual stocks have within that sector, how they perform, trying to find, using them as a means to possibly filter for stocks that are going to have some action in them, as it were. Williams is the one that I saw. You might want to explore that a little bit more, primarily because even though they've done a performance of 30%, which is below the performance for the XCL. The XCL performance is 48, but it's pretty good because what I was trying to explain earlier, it has a very small weighting in the sector. So to me, that's done, as very well. And the other thing about you have to remember with Williams is the cost of the stock. And looking at it, if you look back on the weekly chart, it actually started to move higher. The energy sector put in a double bottom, and it really motored at the back end of 2020, which propelled it and made it the best performing sector in 2021. But Williams, actually, this is the weekly chart, is a really nice chart. As I said, particularly when the stock is only $10. Traders are always looking for good value stocks. They have very solid fundamentals, and it's quite interesting looking at the profile, the analysts' ratings. They're all saying, oh, it's a buy. But actually, the buy has really kind of, most of it has gone, and so we're possibly looking at certainly a pause point on the daily chart. As we can see here, it's had a bit of a pullback today. Let's have a look. It could be, people will see that as a buying opportunity, put in a big down bar. Don't know what the volume is going to be on that one. We'll have to wait and see. But it's interesting that looking at the monthly chart, we can see why we are now at a pause point, because we are at the volume point of control and moving into this area where we have this huge congestion. We have got good support with the accumulation and distribution, support and resistance. Now, the beauty of the accumulation and distribution indicator is that this line, these lines, not the Vpoc, which is the yellow line, the red and the blue, they get thicker. The more times this is tested and holds, it gets thicker, and that tells us it gets stronger. Because the one thing about support and resistance, no matter how you measure it, Fibonacci, you draw the lines on yourself, you have no way of knowing how strong that is. This indicator tells you. The stronger it is, then the more it will hold. And it will also tell you for to go through, it is going to need lots and lots and lots of volume. Now, the issue with Williams is that it's caught now between the volume point of control and a very, very strong resistance here. But if it goes through, boy, oh boy, it will provide an absolutely stonking strong platform for it to carry on higher. And you've got a low volume nodes all the way up. Whether it goes back to 60, we don't know. Part of it depends on what the energy sector does. If it carries on higher, then I think, it could push this stock higher as well. Right, I will pass you over to David. If you've got any questions, please just drop them into the chat.
Hi everybody, welcome back. I've got 2 or 3 things I just want to highlight here. I'm actually starting with gold, and really a couple of trap moves. I've got one on gold here, and I've got one on Tesla as well intraday. But I wanted to start with gold on a really strong signal that came in yesterday. From a VPA perspective, we've written about gold extensively. We've traded gold over the years. We did some analysis on it. I think, where are we? Wednesday, probably Tuesday, maybe yesterday even. Could have been Monday. I can't remember now. Because gold has been gold traditionally, given the roaring inflation that is taking hold everywhere, you would normally expect gold to really, really be trending higher quite strongly. Sorry? Yes, as Anna said, they've gone into Bitcoin instead, which is fine. Typically, I say typically in a, I don't say perfect world, but in a conventional sense, that is the part, if you like, that gold plays. Other than obviously it is a precious metal, and it has that asset value. But from a financial perspective, it is the safe haven. To protect against inflation, against rising inflation. That is typically when you will see gold rise. And over the last couple of years, 18 months, that relationship has really not been established. It's a broken relationship, but it's certainly nothing like as strong as it used to be. And given the levels of inflation we're now seeing, I mean, you're seeing it literally every day. You're seeing it in terms of just regular consumer goods, regular food. You're seeing it in energy prices. You're seeing it in all sorts of different ways. You're seeing it as a knock-on effect from COVID. We're seeing it in terms of building materials are rocketing, a short supply. Goods are not moving freely around the world. It's all over the place. Oil is climbing again up to $85, $86 a barrel. All these things are compounding this inflation driver, but you're not seeing it in gold, which is interesting. That said, we've been in congestion for a while, and gold has been trying to break away from the volume point of control here, down just below 1790 per ounce. We had this level in here, which was actually the level I think we wrote about in the analysis, where it's been tested, and it keeps falling and keeps falling. Now, what's interesting is yesterday, look at the volume that came in yesterday on the daily chart. It's huge, and yet we've got a narrow spread candle. Now, from a simple VPA 101 perspective, that is anomalous. It cannot be anything else but anomalous, because if you look at any other candle here, you look at this widespread candle, we had, slightly less volume under there in a huge down day. You look at this candle here, another down day, half the volume there. So what is this telling you? It's telling you that if this were not anomalous, to use a tautologist phrase, then this candle would have been greater than this one and would have been 1780, 1770, 1760 even, a really, really big down day. And yet we haven't. What have we got? We've got a narrow spread candle on massive volume. And what that is telling you is that this is buying. It has to be buying. It can't be anything else but, because otherwise the candle would be down here. So we've got very strong buying coming in yesterday on this candle with a ton of volume. Now, as I said earlier on in one of the webinars, it does not automatically mean we see these signals, we think, fantastic. You know, this is a really, really strong signal. I'm going to take a long position, I'm going to jump in here, I'm going to take a short position. It does not automatically mean that the reaction to that signal is going to happen the following candle or the following day. This occasion it has, but it doesn't always happen like that. It could have been here, we could have been sat here, and you know, into early next week, we could have gone sideways, but nevertheless, it is indicative of very, very strong buying, and indicative that if you were going to trade one or the other, the probability of the market going up is much, much stronger to go to the upside than a development of a downside back to the volume point of control, which is what we are seeing today. Now, I've got the volume switched off on here because I've got so much data coming in, so it's on bar close or on candle close. But it will be interesting to see, very interesting to see what this level of volume is once this candle has closed off, because the key thing now, as we pointed out in the analysis, is that first of all, we need to breach this level here and hold above it, which it looks as though it will for the day. And the second point thereafter was then really how the price reacted moving into this low volume area. We have a low volume node on the Vpoc here, right the way up to 1855. So in terms of progress higher, and indeed on towards the 1875, 1880, where we got to before. So the whole of this volume in here, this is slightly elevated, but certainly in here, it's a low volume region. In terms of progress through here, it shouldn't require as much volume to penetrate this massive volume here that's sitting here than it would take, for example, to move through this lot, because volume works in exactly the same way as price-based resistance does, or support. If you've got minimal volume as you have here in terms of a low volume node, you would expect, all things being equal, the price to move through there fairly quickly, because there is nothing in the way of volume-based resistance to act as a barrier to progress. You've got an absolutely minimal level here on the accumulation distribution that is insignificant. It's only been tested once on the level, so that is not significant. Nor is this. This is what's significant, this low volume node here, because the price should move through there fairly quickly. So all things being equal, if we get decent volume coming into this and we get a follow through Thursday, Friday into next week, we should see gold move pretty smartly up to around 1860, where it hits a little bit more stiffer resistance up here. And then it's a question of whether it's going to do this again, or is it going to break through there? And this is the point. If it breaks through here, then we could be off to $1,900 and beyond. I think we went out to a slower time frame chart as well on gold on the slower time frames out to the monthlies, I think from memory, or that may have been oil. Now, what I wanted to show you on this chart, on this complex of gold across the time horizons, was the trap move. We've seen it here. Here it is. What did I say earlier on? When you get volatility with volume, that is when the big operators, the market makers, are in the market. This is not to say this move has come to an end, but as soon as you see this combination, the volatility is triggered. Again, this is on, what are we on, 10-minute chart here. We're on 10 minutes, so I can't see it behind the time and sales. 5-minute, beg your pardon. We're on the 5-minute time frame here. Now again, I don't know if the market did this, rushed up, trigger came in, and then we've had some oscillation around with this, some selling coming in on profit taking. But rest assured, the big operators are playing in here. You can tell that from the volume. And what we're expecting as a result of this is one of two things: either a congestion period, which is what we're seeing. We're at the volume point of control, which is just confirming that. The volume is building right out over here somewhere. Pull that in a little bit, there we go. So we've got price action now sitting on the congestion on the volume point of control, which is what we expect. And as I said before, if you were in this move, and the reason that these moves are so profitable for the market makers is because it's the fear of missing out. You see maybe you saw this candle come in and you were a bit unsure, uncertain, move through this low volume node pretty quickly, which is what we expect to see. Then the price starts to snap high very quickly, and you don't want to miss out. So it's a fear of missing out, and you jump in. Now you're sitting in congestion. Now all may not be lost for the time being because it doesn't look as though it's going to come to the downside for the time being, but nevertheless, this is squeezing your emotions, because now there's uncertainty, there's doubt, there's fear, there's everything else coming into the market, and you're not sure which way this is going to spring. Are we going to carry on up to 1840 and clear the high of this candle, or are we going to come off here and we're going to lose all our profit and probably get stopped out on the way down because there's a low volume area in here? So there's very little in the way of support under this price action. So the volatility, the indicator, is just so powerful, works on all these different levels. And in this case, it was also confirmed. We had it both on 5, and we've got exactly the same configuration on 10 again, with huge volume coming in. The trend monitor, you can see, is very much blue. You know, it's maintaining that positive outlook for gold. Still trying to press higher, but we're in congestion. We've got to wait, and be patient. So, you know, I restate the point. If you see the indicator and it's triggered in real time before the candle closes, fantastic. Take your profit, sit tight, be sitting here now, waiting. Is gold going to go higher? If it does, once it clears the high of that candle, we can jump back in and, you know, off we go on the next leg high, if that is indeed what is going to happen. Now, if we head on down to stocks, I'll go back onto the indices in a minute. Just see where they are. They're all looking a bit bearish at the moment, pretty sick. This is Tesla. And again, this is another trap move. If I pop open the 3-minute, what we saw was, again, it's combined with volatility, but the power of the trap move here is in the gap up. The gap up came because Tesla was trading higher pre-market rather. So in the pre-market, Tesla was trading higher, and one of the many aspects we're going to cover, sorry, let me just switch that off, get rid of that. There we go, just shut that down, close that. There we go. One of the many things we're going to cover in obviously the stock and the stock trading program, and it's not just stock trading and investing, it's also covering all the other aspects, trading direct into the market through stocks directly, trading indirect through options, VIX options, index options, all those sorts of things, and all the various ways of getting into the market through spread betting, ETFs. There'll be a big module in ETFs, all these sorts of aspects. But the pre-market is important because what the pre-market does, it kind of sets levels. The reason that stock traders look at the pre-market is to try and get to gauge some level of interest, of levels of resistance, of levels of support, which then help in terms of once the cash market opens alongside all the other markets as well. And you see it here, it's a typical gap move. Now, you know, there's an old maxim in trading which says gaps get filled. Nothing is guaranteed in trading, and these things are in terms of gaps, it is one of the truisms that is often the case because of the fact it is associated once again with market makers and this whole business of emotion. If you see a market snap higher or lower at speed with a gap, your instinct is to jump in because you don't want to miss that move. And again, it's the fear of missing out. And what the fear of missing out does, it triggers that emotion. I've got to get in. I'm here to trade. I'm here to make money. Oh, that's moving. You know, I've been maybe looking at, I don't know, a stock or an index hasn't been moving, and this suddenly decides to move. Bang, I'm in. And you know, this is what happens. Gaps get closed, and it's a classic. It happens at all sorts of times, but particularly around, obviously, when markets are catching up, particularly stocks. One of the excuse me, I'm just going to switch off for a moment. Bear with me a moment. One of the issues with stocks is clearly that they don't trade 24 hours a day. Indices do, pretty much. Forex does, pretty much. And stocks, surprisingly, trade quite extended hours. You'd be amazed that with the pre-market and aftermarket, you're probably looking at something like 14, 15, 16 hours of trading. There is a move. Ultimately, there will come a time when stocks do actually physically trade 24 hours a day. Now, clearly, exchanges are always open around the world at some point, so there's always a sentiment indicator or indicator of sentiment somewhere in a physical exchange that is working. And at some point, maybe 24 24-hour stock trading will come inevitably, I think, because we are looking at very extended hours either side. But this is what happens. What you're seeing at the moment in terms of stocks is you get the pre-market price action and you get these gaps in the chart. It's unavoidable, it's part and parcel. So please be aware of it, and it's even more reinforced by the fact not only have we got the volatility trigger, it's confirmed with the volume as well. And what we're seeing on Tesla is pretty much what is going on in terms of really nice move on Tesla here to the downside. You know, it's not stressful. And one of the, let's just pop that up, one of the aspects that is absolutely fundamental to really any trading, but particularly so in terms of stocks, in terms of stock options, is the whole business of volatility. We're seeing it in cryptocurrencies. It's really driving the cryptocurrency traders mad because volatility has drained away in that market. There is no volatility, and so the cryptocurrencies are range bound in pretty narrow ranges for that market. They are used to trading high volatility, and that volatility is drained away. Pretty much the same on Tesla here. It's kind of draining away. It's moving sideways all the time, quite a wide range, but we have the volatility candle and we're trading around this volume point of control. You know, Tesla aficionados, if I can put it like that, really, you know, this is what they love to see. They love to see, you know, this skyrocketing of their beloved stock, moving upwards, ever on upwards, you know, like a skyrocket. Well, at the moment, it's in congestion. And this is the issue, particularly if you're trading things like stock options, which are all about time and volatility. You know, this is a classic stock for tremendous returns very quickly because you've got a volatile stock that really does move, and it's a big one as well. But at the moment, it's just drained away completely, and that's where we're trading at the moment. But from an intraday perspective, very different, very tradable. You can see it here. We've got the trend monitor on all time frames. This is on the 1 minute. This is on the 2 minute. This is on the 3 minute. I mean, I like to have, I'm sure many of you know, I like to have the 15-second up as well. And again, of course, you'll see that snap move to the upside, that trap move to the upside. You'll see it reflected in all the time frames, and it's reflected in terms of VPA. It's also reflected in terms of the price action. You know, these are not particularly strong-looking candles. You know, effort to rise. You had a little bit of buying coming in there, more effort to rise. You know, looks pretty weak. Then you look at the rally here. What's the volume like? Well, it's okay, yeah, but it's, you know, we're back into, then you'd be looking at it from a support and resistance perspective. We've got quite a lot of volume here on the Vpoc, so that's going to come into play at that point. Price action is very limited in terms of resistance there. It's quite lightweight, and then on we go, down we go again. What's the volume look like here on this little rally? Not looking particularly strong. This is the point about the trend monitor. What does the trend monitor do at this point? It goes into a transitional color. We then roll over, it comes back out again, a little bit of more transitional color, and it just goes back into its shell. So it never actually gets anywhere close to a darker blue, for example. It's just oscillating between bright red and darker red. In other words, yeah, we're bearish. Yes, we've got a bit of slowing of momentum in the bearish trend. Now we're coming back out, maybe a little bit of slowing again. Now we're coming back out again into faster momentum to the downside, and on down we go. Really nice trade on this one. You know, the volume confirming here, we're off down again, that's fine. Look at the weakness under the little candle to the upside. You know, yes, it's in agreement, but it's hardly demonstrable of, you know, strong buying under that particular phase of the price action. Let's go up onto the 2 minute. The other indicator I like to have on here as well is one Anna has too, which is the Tick Speedometer, which gives you a sense of real momentum in the market, because you're looking at the tick flow through the market, and obviously non-time-based charts like Renko, like tick charts, again, fantastic for revealing momentum. What you don't see on a time-based chart is momentum. You do see it on a non-time-based chart like a tick or a Renko, because those two charts are non-time based. In other words, what governs them is not time, but some other metric. In the case of tick, it's how many ticks you've got set to the chart. And in the case of Renko, it's how many bricks are set, whether that's automatically, as indeed occurs on the Renko NinjaTrader version that we've developed, or in terms of brick size that you've set yourself. So this is a really nice little price move lower. You know, there's nothing really to frighten the horses there in terms of, you know, jumping in. And if you were not in this trade, as I said earlier on, if you're looking for somewhere to get in, maybe what you've got to wait for now is you wait for a congestion phase to develop, you wait for a pullback to develop, you wait for a stronger signal rather than jumping in just on hope at the moment, although it's looking pretty good. Maybe you just wait and see what happens next as that trend lower develops. But a really nice move there. So it just makes the point from a daily perspective. Option traders will be tearing their hair out because time value is wasting away, volatility has drained away, and their option values will be decreasing at an alarming rate, particularly if they're coming towards expiry any time soon. And particularly even more so if they're trading on the weeklies, they will be absolutely being crushed at the moment and killed in there. Let's just go and have a look and see what the indices are doing. Yeah. There we go. I'm not sure. I think I closed the Aussie dollar down actually on the charts. But there we are. This is on the three of them. This is on the YM. This is on the NQ. This is on the ES. That's on the daily. And the top line is on the 5 minute. And they all have to say pretty much the same today. So it's we had a heavy selling day yesterday. Just pull that up on the YM. A lot of selling under there. Lots of volume, rising volume, crescendo of volume, if you like, and spreads widening. Classic signs of weakness. Let's pop this one up as well. Not quite so much demonstrable volume under here, but nevertheless, price and volume in agreement here, strongly in agreement. There's no disagreement there. The volume's good. The price action's nice and wide. Little candles top and bottom, but that's a straightforward, yeah, price and volume in agreement. Wyckoff's third law, cause and effect. That's all fine, good and dandy. What we've got developing here at the moment is if you like, a elongated doji candle. There's a wick here. You might not be able to see it all down here. Wick at the bottom and a narrow spread to the body of the candle. And similar on the ES as well. So they're all in agreement, which is unusual. In the past, the NQ has been very much the leader of the pack. It's actually leading the pack lower at the moment, to be honest. But you do get divergence. Do not be misled by thinking that because these indices are all risk assets, they all move in the same way. There are many different reasons why they move in different directions on the same day. And again, we're going to cover that in detail in the program as we move through it. Let's just go and have a look at oil, because that's interesting too, adding to good for the energy sector, and obviously adding its own weight to inflation as well. There we go. Let's pop up the daily there. This is on the daily, and again, we did an analysis on oil, again, I think yesterday or maybe the day before, looking for oil to, I think when we wrote it was about 84, 40, 50, something like that, looking for it to get up to 85, past 85, which we cleared yesterday. Sorry, we had a gap up today. We've cleared that. We're up at 86.17. So oil is looking pretty strong, looking for that to go towards, I think around the first stopping point is $88, $89 a barrel. And then if it gets to that level on the slower time frame charts, we could longer term see it go to triple figures in due course. So very bullish on oil on that one. What else do we have here? Let's just go back. Let's go on to multiple time frames. There's always a nice workspace. There we go. One of my favorite charts, the 15-second. Pop that up full size. Not because I'm suggesting that you trade a 15-second time frame chart, but if you want to learn VPA and really get into VPA quickly and hone your skills, then using a fast chart like this is invaluable. When we started, we used, I remember it well, we used to print things off and then roll them up or cover them up and then gradually peel them back. We used to test one another like that. It sounds very basic, but that's what we used to do. And it's just a very quick way of learning. What have we got going on here? You can see this is a nice downtrend. We come all the way down through the Vpoc, come down here. We get some decent buying coming in under here, no problem at all. What's that followed up by? We get a 2-bar reversal here. So this is basically exactly the same as that, not identical, but pretty much the same. So it would have a little green body and a nice deep wick. Not much volume under that, but certainly it just reinforces the fact that we've seen strong buying coming into that. So we're looking at possibly, reversal. But the issue is, if we were looking at taking a long at that point, the next question you've got to ask yourself is, where is this going to go to? How far is this journey going to take me? Is it going to take me very far, or is this just a quick and dirty trade? Well, if you've got the Vpoc here and you've got some strong price resistance above it, it's not going to go very far. So if you're comfortable taking a trade that's only going to net you this number of points, which is healthy, I mean, 20 points is healthy by anybody's stretch the imagination, but that's the point. Is that, are you happy taking that? Is that a risk-reward relationship you're happy with? It's not a 2-to-1, 3-to-1 nonsense, all that rubbish. This is about looking at the chart, deciding for yourself what is on the chart from a technical perspective that is likely to cause this move that I'm considering a problem, where it's going to run into some issue that's going to cause it to pause. And it's pretty obvious here where it is. It's here. It's going to slap back in front of you. So if 20 points is enough for you, fantastic, take a trade. If it isn't, don't bother. What does it do? It runs into the resistance here, runs into the Vpoc. No great surprise. You've also got weakness signals here. Pivot to the upside. Volume's okay under that one. Even stronger volume under that one. So that's not going anywhere. Pivot to the top side again. It's not going anywhere. Now what you've got coming into play as a move to the downside, if you're looking at a move to the opposite direction, is this level here. It's very strong. It's just literally testing as I'm talking to you. This is tested me 9 times on the accumulation distribution indicator in the past. Therefore, it's very strong. You can see visually it's strong. Looks as though it's going to go through that, pierce that. Happy days. We've gone through that. You might decide to jump in at that point. You've got rising volume, you've got widening spreads, and you've got rising volume, and you've got a trend monitor that's starting to transition back into a bright red as well. That's how quick you have to be. But it's, that comes with practice, it comes with experience, but it comes with also reading charts all the time in this way as well. You're looking at this in multiple time frames. Again, that was up on 15 seconds, very quick up there. But you'd be coming out, you'd be scaling out. Look at what's going on over on a 3-minute, for example. Let's see what's going on here. Okay, we had this little rally. We've had similar volume here. The market really doesn't look very strong. We had a doji candle here, indecision, not necessarily reversal, but just showing that the market is undecided. It's not a reversal signal of one way or the other. It's just indecision. Take it at face value. It's indecision, unknown. It doesn't give you a strong signal as to future direction. And then you drop down onto the other time frames as well. Drop down onto 10. What have we got on 10-minute? Much lower time frame here, but the trend monitor's transitioned out to red. We've got a nice price waterfall here. We've got nicely rising volume, and we're probably going to get a bit of a pullback. These happen in all markets, all time frames. The key will be, what is the volume under here? You've got resistance overhead. You can see it literally being tested here again. This is on the accumulation distribution again. Decent area. You've also got another area here. These were a little bit closer. They would act in combination as a cluster of two. There you see it's just capped it off. So that's been tested and held for the time being. Doesn't mean it's going to hold on the next candle, but nevertheless, it's just reinforcing that level of resistance there. There we go. I think that's it. I think we're probably done for the day. Just check and see if there are any questions. No, I think we're good. Okay, fine, lovely. Thank you so much for coming along today. Hope you've enjoyed it. We will be back next week with more of these much shorter webinars. So it's very much because of the video length. The longer ones, it's much easier. People don't have a lot of time these days, and even watch a video for 20 minutes, 30 minutes is quite a long time. So that's the reason we've chopped them down in this way. So there we go. Enjoy the rest of the trading session. Enjoy the rest of the trading week. We will be back next week with more of these. So hope you enjoyed them. See you soon, and bye for now.